The world is buzzing with excitement. Artificial intelligence is everywhere, and NVIDIA is at the heart of it. Their powerful chips are fueling this technological revolution. But is this truly a new era or just another tech bubble waiting to burst? AI's potential feels enormous, promising to reshape industries and change how we live and work. Many believe this time is different with technology advancing at breakneck speed. Yet history reminds us to be cautious. Remember the dot-com boom? Human psychology drives markets, often making us forget past lessons. Greed and fear are timeless market movers. So let's take a closer look at NVIDIA's current standing and the wider market dynamics. What forces are truly at play here? There are no easy answers, but asking the right questions is crucial. By looking at the facts, we can make more informed decisions. This journey starts with understanding the hype and the risks. Is this the dawn of a new age or a bubble about to pop? Let's find out. The stakes have never been higher. The future is uncertain, but the opportunity is real. Let's dive in. NVIDIA just announced a stock split. What does that mean? Each share divides into more shares, lowering the price per share, but the company's total value stays the same. It's like slicing a pizza into more pieces. The pizza doesn't get bigger. Investors often get excited, thinking the stock is more affordable. This creates a flurry of trading and headlines, but it's mostly psychological. Remember Tesla's 2020 stock split? The price jumped, but the company's value didn't change. Stock splits don't add real value. They just change the number of shares and their price. It's financial engineering, not business growth. The real drivers of value are innovation, profits, and long-term strategy. Don't get dazzled by superficial changes. Focus on what truly matters, the company's fundamentals. Stock splits are common, but they don't make a company stronger. The excitement is real, but it's often short-lived. Investors should look beyond the headlines. The real story is in the company's performance, not its share count. Don't confuse hype with progress. The market loves a good story, but facts matter more. Stay focused on the fundamentals. That's where real value is created. Don't let the buzz cloud your judgment. NVIDIA's stock price is sky high, and the market's expectations are even higher. One way to measure this is the price to sales ratio, or PS ratio. It compares the company's market value to its annual sales. NVIDIA's PS ratio is much higher than competitors. This means investors expect explosive growth, far more than its peers. But high expectations come with high risks. Remember Cisco in 2000? Its PS ratio soared during the dot-com boom, then crashed when reality hit. A high PS ratio means the stock is priced for perfection. Any stumble could trigger a sharp correction. The numbers tell a story of optimism and risk. It's a reminder to look beyond the hype. NVIDIA's stock price already reflects massive, sustained growth for years to come. Investors are betting on near-perfect execution and relentless expansion. But growing rapidly from such a large base is incredibly tough. The law of large numbers makes it harder to accelerate. Competition in AI chips is fierce. Giants and startups alike want a piece of the market. Disruptive technologies could emerge at any time. Markets can become saturated, and innovation is a constant race. NVIDIA must keep out innovating every year. That's a monumental challenge for any company. Yes, NVIDIA is an excellent company with visionary leadership and top engineers, but its stock price demands flawless performance. Any slip could disappoint investors and send the price tumbling. The bar is set incredibly high. The company's greatness is not in question. The expectations are. Can NVIDIA keep up this explosive growth, or will reality catch up with the hype? Investors need to weigh the risks of such lofty expectations. The pressure is immense, and the margin for error is razor thin. It's a high wire act with little safety net. The challenge isn't just to be great, but to be perfect. That's a tall order for any business. Global politics are reshaping the semiconductor industry. The US and China's tech rivalry has direct consequences for companies like NVIDIA. National security concerns are driving new trade restrictions and export bans. These rules can change quickly, creating uncertainty for chip makers. Planning becomes difficult when regulations shift overnight. China is a huge market for AI chips. Losing access could hit NVIDIA's revenue hard. It's not about NVIDIA's skill or innovation, it's about geopolitics. National interests can override even the best business plans. This is a major headwind for the entire industry. Investors need to watch these risks closely. For NVIDIA, the world stage is as important as the lab. The next move could come from Washington or Beijing. NVIDIA's profit margins are among the best in the industry. High margins mean more money for growth and shareholders. But these margins aren't guaranteed. They can shrink as competition heats up. More players in the AI chip market could drive prices down. Customers may demand lower prices as technology matures. Rising research and development costs could also squeeze profits. Even a small drop in margins can have a big impact on overall profits. With the stock already priced for perfection, any slip could trigger a sharp decline. Investors need to consider this risk seriously. Financial models are sensitive to margin changes. It's not about predicting doom, but understanding vulnerabilities. Smart investors think about what-if scenarios. Both upside and downside risks matter, especially at high valuations. Overwhelming optimism can blind us to real threats. Being aware of potential margin pressure is prudent. It helps make more balanced investment decisions. The market rewards strong performance, but punishes disappointment. Margins are a key metric to watch. Don't assume today's profitability will last forever. The landscape can shift quickly. Stay alert to changes in competition and costs. That's how you protect your investment. So, how should investors approach this high-stakes, high-hype market? Don't put all your eggs in one basket. Diversification is key. Consider hedging your positions with options, like buying puts for downside protection. Invest in a basket of chip companies, not just one. Include designers, manufacturers, equipment suppliers, and AI software firms. Spreading your bets reduces risk. Do your research and due diligence before investing. Don't get swept up in the hype. Focus on fundamentals. Stay disciplined and keep your emotions in check. Be prepared for volatility. Stay curious, stay informed, and stay diversified. If today's breakdown leveled up your investing IQ, smash the thumbs up and press subscribe, then ring the bell so YouTube shows you our next contrarian play before the herd catches on. Drop your hottest take in the comments. We feature the sharpest ones every week. Thanks for watching. Stay curious and keep your money moving smart.